Now that we have understood the concept of leverage in Forex, let's talk about margin. Since a trader is allowed to use more capital than the amount he or she deposited, the broker requires an amount of funds to cover any potential losses. This amount is what we call margin. See it as a good faith deposit, represented as a percentage. It is the amount you need to have in your account in order to keep a position open. Let's look at this example. A trader deposits $20,000 in an account with leverage 1 to 25. The broker has set the margin at 4%. What does this mean? If the trader buys 2 lots of Euro/US dollar at 120, you can calculate the margin like this. He must have $9,600 in his account in order to keep his open position. Simple. Free margin, in its simplest definition, is the money in your trading account that is available for trading. It is calculated by using this basic formula. Remember that equity is the balance, plus or minus any profit or loss from open positions. Let's take a look at this example. Say that someone enters a trade with the following conditions, decides to buy 2 lots of Euro/US dollar at the exchange rate of 1.20. So the transaction will amount to $240,000. The required margin for this position is calculated as follows. 240,000 divided by 50. If after entering this trade the price of Euro/US dollar fell to 1.1905, he incurred a loss of 0.0095 pips, which is equivalent to, in this case the trader's free margin would be Margin level indicates the health of your account. It is the ratio of equity to margin used for your open positions and indicated as a percentage. It's easily calculated with the following formula. Let's take a look at an example. Say a trader has the following equity and used $1,000 worth of margin. As we can see, this trader's account is still very healthy. A basic rule of thumb is the higher the margin level, the less possible it is for the trader to face a stop out. This is a notification which alerts you that you need to deposit more money in your trading account or close losing positions to free up margin. Margin call is denoted as a fixed percentage determined by the broker. You can find the margin call percentage in the account specifications of your trading account. When the market is moving against your open positions and the margin level falls to the margin call percentage, you can expect to receive a margin call warning on your device. In other words, it is a warning for the trader that the stop out level is approaching. In the example here, the trader is getting closer and closer to a margin call. Don't forget that your margin level is your equity divided by used margin times 100. If his margin level decreases further to 40%, he will get a margin call. So make sure always to keep an eye on your margin level, guys. Now that we have covered free margin and margin call, it's time to look at stop out. Stop out is the level at which the broker starts closing the least profitable open positions in order to free up margin. At FXTM, you can see at which point stop out will be initiated for each trading account in the Trading Accounts Overview section. As you can see in this example, there's a stop out level of 20%, while the margin call is at 40%. What does this mean exactly? Well, in this case it means that once the trader reaches 40% of his margin level, he will get a margin call. If the trader doesn't start closing his least profitable positions and he experiences further losses that bring him to 20% of his used margin, stop out will be triggered. So now you know what stop out is. Here's hoping you never have to experience it. Till next time.